Welcome back. In this video, I'm going over 4 tax strategies for paying yourself in your business and saving taxes. This is part 2. I have another video that goes over how to pay yourself in your business, whether it's sole proprietor, self-employed, LLC, corporation, S-corp. And so be sure to check out that video for the basics. In this video, I'm going over 4 strategies that are more advanced situations for people who are a little further beyond, who want to save taxes. So with that, let's jump into these 4 strategies for saving taxes in your business. Before we do that, my name's Amanda. If you're new here, you're watching The Business Finance Coach, where I simplify business to help you succeed, because I believe that the world needs what you have to offer, and you can actually feel supported by these tools of our civilized society instead of held back or overwhelmed by them. I have free templates and mini trainings, as well as full-blown courses that you can check out in the description below. Now let's jump into the 4 tax strategies for how to pay yourself while saving taxes. One thing to keep in mind is that there is not a simple choice that everyone should make that saves them taxes. And I realize the way some people out there, even on YouTube, are talking about some options, it would appear that that is the case, that you could just form an S-corp and save taxes, and that's not how it works. These things are very dependent on your situation, and generally you need to have a certain amount of income in your business before any of them are going to be applicable. So when we look at the cheat sheet from the last video, sole proprietor and single member LLCs, they don't really pay themselves for taxes. They're taxed on their net income. And so the first tax strategy we're going to talk about is for multi-member LLCs and partnerships. Of course, multi-member LLCs are taxed as partnerships, and there are 2 aspects, tax strategies, that apply to multi-owner businesses. The first one is to keep guaranteed payments as low as possible while we have this qualified business income deduction, the QBID deduction, because the smaller your guaranteed payments are in a multi-owner business, the higher your QBID, that 20% of income deduction, is. And therefore, you're saving taxes. So what are guaranteed payments? What guaranteed payments are is an allocation of net income first to one partner. So remember, self-employed people, they're just taxed on their net income from a business. In a partnership or multi-member LLC, taxed as a partnership, the owners are also taxed on the net income of the business, just based on their share of that income, based on their ownership or special allocations. So 2 partners, 50-50. They take the net income from the business and they're taxed 50-50. Well, let's say one owner is actually working in the business, and so we want to make sure that owner gets paid. Remember, we can't use 1099s. We can't use W-2s. And so guaranteed payments is the tool that we use in a multi-owner business to allocate a portion of net income first to one owner. But you want to think about this as a salary, and it's a set amount. So this cannot be a percentage. If you just say 10% of net income goes first to one owner, that's not guaranteed payments. And so you want to strategize in that way in a multi-owner business while we have this 20% pass-through deduction, because not using guaranteed payments is going to save you taxes. Now you can see this is my business tax comparison spreadsheet template. And so this is where you can put in guaranteed payments, but again, these aren't required. And so leaving these out allows us to have lower taxes because we have a higher 20% QBID deduction right here, our 20% pass-through deduction. So let's do that. We're now at $4,390 for all of them. If I pop back in Now we come down and our 20% pass through, just allocating that 20 or 40,000, look at the difference in the 20% deduction because it's based on this amount and we just moved a bunch of that net income down to guaranteed payments, which don't count for the pass-through deduction of 20%. Now, the second way to save taxes applies to the same situation, multi-member LLCs or partnerships, and it's by having an owner that's considered a limited partner because limited partners don't pay self-employment taxes. So the general rule on those templates I just showed you, whether you categorize it as guaranteed payments or the net income from the business just flowing through to the owners are going to pay self-employment taxes and income taxes on their personal return, which is all being calculated on that spreadsheet template. When one owner is a limited partner, it means that there's no self-employment taxes. Now, limited partner, general partner, these are terms that apply to the partnership and not multi-member LLCs. And this area has never been overly clear. However, when we look at LLC members, we get to decide, are they more like a general partner or more like a limited partner? What makes a partner limited is not necessarily the individual roles that they play. It's based on the influence that the member owners have on the business. And so one of the biggest distinctions that court cases have shown us is that if the business is manager managed when the LLC is formed versus member managed, that's a good key criteria for keeping some of the owners under a truly limited partner type of owner. And so you have to have general partner types in the business as well to actually be responsible for running the business. And then the limited like partners or members in an LLC, they actually have no control or decision-making ability in the business. And if we look back over at the multi-owner business types comparison spreadsheet here, we can see under our partnership LLC, we have the option to select general or limited partner. And if we select limited partner, when we come down here, our self-employment taxes are gone versus here they are happening for all of the other owners. So I would recommend looking at this as a tool for allowing for people to be involved or partner with you in a business in a way that allows you to save them 15% on taxes. Keep in mind, if their income is far above $100,000, then those amounts of taxes get much smaller after that point. And so it is kind of less of a tax savings. Granted, people always like saving taxes regardless of how small they are. So it's still a good structural, aspect, and you're not giving up any control of your business in the process. Number 3 is the good old S-corporation. So the way the S-corp pays taxes is that it's just like the partnership. The net income from the business, it flows through to the owners. And they pay taxes based on their share of owning the business. And they pay income tax on that share that comes into them. They don't pay self-employment taxes, which of course are the same thing as payroll taxes, the Social Security, and Medicare. And that is why in the S-corp, you must pay yourself reasonable compensation so that you are paying those self-employment or payroll taxes, Medicare and Social Security on the income you worked for, because that's the way our rules work. In the S-corp, there is an opportunity to save taxes if the amount you could pay someone to replace you doing your job in the business is considerably less than the money you're actually profiting in the business. The excess income over your expenses, your net income. If that's substantially larger than your reasonable compensation, then it can be worth it for you to go the route of the S-corp. Now, this comparison template that we see here is for one person. So we're comparing self-employed to being in an S-corp. So we have two columns for the taxes the business paid and the taxes the individual owner pays, and same in the corporation. And this is where we put in our owner's salary. And so we can see in this example, we only have 50,000 net income. So we're going to pay at least around that much for an owner in a business who's doing substantial or any sort of skilled work in the business. Now, to get this number as low as possible, I do go over reasonable compensation in the course I talk about, and I have this template that walks you through ways to actually calculate that as low as possible. And it really is about documenting and researching and, getting different pays online and showing how you're coming up with your number. That goes a long way to justifying your amount, but you certainly don't want to do anything ridiculous like 10, 20,000 on your W-2 and the rest in dividends. Like, that is not legitimate. So I would never really go below 50,000. And so if you're not netting 50,000 a year, then it's going to be really difficult. But let's change these numbers. Let's make this 200,000 in sales, 50,000 in expenses. Maybe we'll do 55,000. And so we've got a solid 90,000 in net income after our payroll, after our owner's salary. So in this type of situation, we can see here's the 150, the net income when you're self-employed, being taxed for all of those self-employment taxes. In the S-corp right here, we have none, zero. And so here we see our payroll. Now we're down to calculating our personal income taxes, we have our wages, and we have the net income coming through. Versus when you're self-employed, it's just the full amount for both self-employment and income taxes. And so down here, you can see that we're combining all the taxes in the S-corp business and as the individual. And so the S-corp is only paying $22,000 versus $31,000 in the self-employed business. And you can see up here, calculating the full cubed, it's only based on 20% of the 90,000 under the S-corp versus 20% of our total income coming through minus our self-employment taxes, and that gives us 27,000. So even though we got a much bigger deduction in the self-employment under cubed, this was enough net income to make it worthwhile. If we increase this number to 100,000, which certainly being paid 100,000 to run a company seems rather reasonable. So now we've only got 42,000 flowing through. Now look at how close we are. $31,442 under self-employed, $31,102 under S-corp. And this is why, I always say to people, you've got to run the numbers for your situation and how you think it's going to go in your business. It's impossible to just say, yes, you should do this or do that. Like, you've got to look at the details more closely to be able to save taxes. And another thing to consider that the spreadsheet accounts for as well is writing off a home office, using your personal vehicle, and health insurance. When you're self-employed, you get to just deduct those on your personal return with your business, no problem. Once you've formed and elected the S-corp status, now you have to take extra steps to be able to deduct those items. You have to set up an accountable reimbursement plan, you have to pay yourself as an employee, and you have to take those deductions and reimburse yourself in the business at least monthly or periodically to be doing things correctly. So there's just a lot more steps in the S-corp. So you want to make sure that you're in a situation where it's really worth it to you. Now, number 4 is probably the least tax savings, but it is still advantageous, and that can sometimes be if you're in the highest income tax bracket, especially based on other stuff you might have going on in your personal taxes. Doing the corporation can be a benefit sometimes. If we head back into our situation here in the template comparing self-employed S-corp and corp for a single owner business, we can see over here on the corporation side, now our net business income is being taxed at 21%. So the corporation is the only time that we can actually leave money in the business because it's being taxed under the business return. But there are still limitations on how much money we can leave in the business and let it build up without putting it out as distributions. And just like in the S-corp, we have to pay ourselves a salary. But here we can see $35,263. We're paying like $4,000 more than our other two types of businesses. However, if we push ourselves into the highest income tax bracket to $1 million, and if we come down here, we can see $203,000 in C-corp taxes altogether, including the business taxes and the personal taxes, versus $230 in the S-corp and $246 in the self-employed. However, if we wanted to actually take this money out of the business, this $842,000, then we're either going to have to increase the amount we're paying ourselves, or we're going to have to take it out as dividends. And dividends are taxed at preferential tax rates. So I hope this is helpful to understand the 4 strategies. To recap really quickly, the first 2 applied to multi-member LLCs or partnerships, and that was to avoid allocating guaranteed payments because that amount of guaranteed payments doesn't qualify for the 20% QBID deduction. Number 2 was if you can categorize a member like a limited partner or a limited partner, if you're doing the partnership, a limited partner will allow them to not have to pay self-employment taxes. Number 3 is electing S-corp status in your business so that you can avoid paying self-employment taxes on the net income that flows through to your personal return from the business to be taxed. If your net income is substantially greater than what your reasonable compensation is, which is a reasonable amount of pay for someone in your type of position, in your type of business, in your region, then you can save taxes. And number 4, sometimes in the corporation, if someone is far above the highest income tax bracket, then they can save money with using a corporation. But we're talking about kind of small amounts, and it takes a lot of planning as there are rules about leaving too much money in the corporation for this very reason as well. Nevertheless, it's a strategy that can help people. So that's all. Those are the 4 tax strategies when structuring and planning how to pay yourself and your business to save taxes. So if you have a small, simple service-based business, nothing to worry about, guys. You are not missing out. When the S-corp makes sense, definitely go through it. I have all sorts of extremely affordable programs walking you through everything you need to do to get set up right in those situations. And I want to get a hold of my spreadsheet template that allows you to compare whether you're a solo owner, a married couple, or multiple unrelated owners, then you can check out the description below for more about those spreadsheet templates and the course where I dive deeper into especially multi-owner strategies and all sorts of fun stuff like this. If you enjoyed this video, give it a like so that YouTube knows, and definitely post comments. I'd love to hear from you in the comments below this video. Let me know what you think, what this applies to your situation, what you're thinking about, what type of business you have. I'd love to hear from you. Otherwise, if you haven't subscribed, consider subscribing and selecting the bell to be notified of my next videos. And I'll see you next time. And my next video coming out is going into details about the QBID, the Qualified Business Income 20% deduction. So I'll see you then. Bye.